Hello and welcome back to our next section, which is basic accounting concepts. So in the previous section we learned the basics of financial statements, who use them and why they need to use them. In this section we will be learning about the basic accounting concepts. So what are the debit side, what is the credit side, which is usually termed into which terms are usually used in the basic accounting: debit, credit, left side, right side of the balance sheet. Then we will be looking at the type of accounts. So there are four main types of accounts, which is income accounts, where we record all our incomes. Then there are expense accounts, which these are the services or the consumption that we use for generating the income. Then there are assets. So these are the accounts that we hold in our hands as in our control. Expenses are something which we already spent out and we consume to generate the income. Assets are which we also pay, which we also consume, but slowly over a period of time. We will be looking at the technical terms of asset when we look at the balance sheet in details. For this point, we just say assets. Assets can be cash, non-cash, and then liabilities. There are fourth term is liabilities, which is also equity and liability to others. So liability means what you have to pay to others. So it can be equity. Profits means the owner's equity and the profits generated from the income and expense statement here, the balance and the others. So in basic accounting concept is that always asset and liabilities are always matching. So if you have assets of $10,000, the liabilities will also be $10,000. Now that can be between equity and others. So let's look at into detail step by step building of these, seeing them into the action. So we talked about four type of accounts: equity, assets, income and expenses. So income and expenses are part of income statement. Assets and equity are part of, or liabilities are part of balance sheet. So liabilities are called sources of funds, which can be initial capital, retained earnings, profits, which we take loan from others. And then the assets side is called utilization of funds. So how you utilize whatever you are earning, whatever you invested, whatever you take loan from, how you are investing that into the cash, non-cash, assets, all those kind of things. So let's look at a starting example of, let's say you started the business with $1,000. So $11,000. So you bring in $10,000 in cash, right? So we give $1,000 in cash here. So you will see the total of both sides is 10,000. In accounting terms, we call this as left side of balance sheet, and this is called right side of balance sheet. This is also called debit side, and this is called credit side. Now why they are called debit and credit, I also don't know, because this is since the starting of accounting, I guess. But for our course, what we will not be using these terms. We will be just using the assets and liabilities. So let's now with $1,000 we started doing the services, right? We providing the services. So let's say we provided the services of total $5,000, and then we got this money cash. We have not yet provided any credit to anyone, so we got $5,000 in cash. So now we have total $6,000. So we can link this one: excess of income over the expenses. To provide these services, we had to pay salaries, right? We have to hire some employees. So let's say we paid $2,000 to our employees, and then we paid them in cash. So we minus cash means we are left with $4,000. We are paying $2,000 salary. So, and then now you can see we have earned a profit of $3,000 so far, where we initially invested $1,000. We earned $3,000. So total we have $4,000. On all those $4,000 we have in cash. So now let's look at some of the utilization of cash. Now we didn't have a car earlier. So let's say we buy a car of $2,000. So we paid the cash. Or you can take a loan as well. We can take from the bank. No need to pay cash for this one. Okay, so now you have $6,000 of total liabilities, say $1,000 from initial capital, $3,000 you earn from profits, $2,000 you took a loan to buy the car. And how you utilize these $6,000 of funds? You bought $2,000 of car, $4,000 you still have in cash. So let's say we buy another asset of, let's say we buy a building, right? So hypothetically, building cannot be in $2,000, but for our example we will use it for $3,000. We paid in cash this time. We don't want too many liabilities, so we are left with 1,000. Total assets we have 5,000. So now you can see we have liabilities of $2,000, but we have cash of $1,000 only, but we do have assets of 5,000. So will we be creditable? We will be credit worthy. We will look at it into details when we look at the balance sheet. Let's now look at providing more services, right? We provided some more services to our suppliers, our customers. So here we provided $2,000, but this $2,000 we are not able to recover all, right? We are able to recover only 1,500 at this moment. One customer, he wants to have a credit of $500 for future, so let's enter that here. So you can see whatever transactions we do, wherever we do, our balance sheet is always tally. Our sources of funds and our utilization of funds always tally. So this is called double entry of accounting. This is called the basic accounting concept is double entry. We can do single entry as well, means we can record a transaction only one side, but then our balance sheet will never tally. Will tally, but and the difference will be our profit or loss. So in this course we will be following the double accounting, similar concept like this. And there are other accounting concepts and assumptions we will be looking at in the next slide. Thank you.